believe.
Yeah.
Exactly. So anyway, so I don't. So this week's "Come Follow Me" reading, section 76 of the Doctrine and Covenants, which is, well, as you all know, is doctrinally heavy. It's probably one of the most doctrinally heavy sections in the Doctrine and Covenants. I was teaching my boys who are getting close to mission age that this is a section where when people say, well, how is the LDS church different from other Christian churches? This is where some of the teachings differ pretty dramatically. But included in that section, or in this week's "Come Follow Me," is a conference talk called what's it called? Something like "Am I Good Enough and Will I Make It?" And if you haven't listened to that yet, I strongly recommend it. It's it's a reminder of how hard we can be on ourselves at times. And the first point of his thesis, of course, is that none of us are good enough. Like, we are not going to earn salvation by being super good. We can't do it. So again, all of my kids have served in the South, and people always accuse them, saying, oh, LDS people don't believe in grace. And we absolutely do. We absolutely believe that without the Savior, none of us is going to find salvation. And then the second point of his thesis is that we tend to be hard on ourselves, and what the Lord expects from us is true and real effort, and true and real honesty with ourselves and with him. It's always interesting that we think we can lie to an omnipotent and omniscient being. He knows everything. He knows the thing you're most ashamed of, right? He knows all of it. And so, if we're earnestly trying and repenting of our sins and being honest to our capacity, right? We all tend to lie to ourselves on occasion, and until we get humbled enough to truly repent and move forward. But if we're doing those things, then according to Moroni chapter 10, then we're then the grace of God is sufficient for us, and we'll not just be saved in the Christian sense, but we'll be exalted, be prepared to receive all that the Father hath. So I just wanted to share that with you. It was an interesting reading, listening to that talk. Again, if you get a chance, it's part of this week's "Come Follow Me." It's worth listening to. It's a short one too. Sometimes you're like, I know it's going to be good, but like the full 20-minute apostle talk, I need like that 12-minute second quorum of the 70 talk, right? Like, my kids think anything over 4 minutes is gross. That's their term for it. My teenagers, oh, that's gross. I'm like, break it into 4-minute chunks then, man, whatever it takes. I wanted to show you, so you probably already know about this, but in my additional study content, there is, some people really find this helpful, a review guide for the exam. It's honestly just me looking through the exam checklist and sort of talking through it. I know it's gross, it's 23 minutes. Some people they're like, that's twice as long. That's like, I barely can listen to Elder Holland for 20 minutes. I can't listen to you for that long. But anyway, that's there for you, and many people find it helpful. And then I also saw another one of the instructors. So when you go on the tutoring resources section, when you just click over here on tutoring resources, let's see, Sister Call. So she's another one of the instructors. She posted Sister Call's Exam 5 test prep video and slides. I haven't looked at it, but it's another resource from a different teacher. And so sometimes it's valuable to see somebody else's, what they have. So I just wanted to point out that I'd seen another instructor had put some stuff up on there. So that's there for you. How has this tutoring resource been? Have any of you used it? Has it been valuable? Is the response too slow for it to be valuable? How did it go? Not using it? Okay. Silence. All right. So
Could you say again your question? My son just interrupt me.
Oh, I said, has anybody used this tutoring resource and was it valuable?
Tutor resource, it means they create the new something the page, and then you can tutoring.
Right, you can arrange live tutoring, and then I see a lot of people posting
Oh yeah,
questions, and the questions get answered by tutors and
oh
sometimes
yeah, yeah. I
instructors.
saw that, but actually, didn't help for me.
Didn't help? Did
For
not?
me, for me, yeah. Like if I have question, I just put on the for the question part,
Hmm.
and and like the broad flags you will answer, or the other student will answer, and I, I
Yeah.
prefer that way. And yeah.
Okay. Yeah. In our section, we have one other student who is, I forget his name, I have to look, but who's super active in your section about responding to people, and he gives really good responses. Sometimes that happens. We have like super student who go in there and like answer people's questions, and other times nothing. It's just like crickets. So anyway,
But
um,
sometimes I still watch that question, and yeah, like you said, you have some super student that answer very quickly to
yeah,
help.
yeah.
Yeah.
And that's the kind of student that you're like, man, if I could give more extra credit, I would. And then you look at their grade and think that guy doesn't need more extra credit because um, his brain is really strong and powerful.
Yeah, and
Anyway,
I saw some people want to share the video that they organize some notes for the exam or the something. But I didn't watch it because still consume time there.
mhm.
One time I watched one video, the one student shared some information that they prepare the exam. Yeah,
Yeah,
interesting.
no, I my goal is always to have more information for you, like rather than less. Meaning you probably
Yes,
won't get to
yes,
use all of it, but at least it's all there for you. And
yeah.
anyway, so I'm gonna share my screen, and I got a little presentation on common stock. So easy, the easiest of all. Don't you love how this class saves the easy stuff for the end? It's a joke. It's confusing. Um, we have you have
Yeah, it's confusing.
yeah,
No.
you have bonds one week and then stock the next, and it's like just so you know, the vast majority of accountants like never even deal with this stuff. Um, it's like it's a specialized branch of accounting. Like, most people I know who get accounting degrees either become CPAs, so they help people with their taxes, which is a whole bunch of follow-on training that would happen, in a master's degree, or they work. Most of them work actually as managerial accountants, where they're working together with some manager to help make cost control systems and things like that. And so these would be like finance accountants, right, who are dealing with the company's stock scenario. And these transactions just don't happen that much. And so if you were like a CPA and you were like, oh man, I got to do some common stock stuff, I haven't done that since financial accounting class, you just Google it. And you would be like, oh yeah, that's how you do it. And you'd put it in there. And so this is part of my frustration with them making you guys memorize so much for exams, because in real life, I've never ever been called upon to do accounting like where I don't have access to the internet, where I can't, but you could say the same thing like doctors. When a doctor leaves the room when they're talking to you, it's because they're Googling something, and that's the truth. They're looking stuff up. I have enough friends that are doctors that are like, excuse me for a moment, I must confer with my colleagues, and then they go to WebMD. Anyway, there are services that a doctor in the middle of surgery can call to talk to a more experienced surgeon and say, hey, I'm having this problem. What do you recommend? Especially for rural hospitals. I'm on an ethics committee at a rural hospital here, and a big hospital, you could just call a more experienced surgeon right there at the hospital, and they could come in and help you. But at a rural hospital, you might be the only one. And so, anyway, who knew that even our experts? What I figure is if a human being can do it, then just about any one of us could learn to do it if we have to. But some things we just don't care to, like stocks. All right, so let me share this with you. Did I already share my screen? I'm just rambling.
Sorry, Brax. Before
Yes.
you sharing this week lesson, may I ask for the final exam? The
Uh-huh.
final exam.
Okay.
What's going on for the final exam? I feel pressure.
Okay. What do you want to ask about the final exam?
Is it for the whole lesson that we have done?
For the whole class, yes. All
Oh,
12 chapters.
oh, okay. So, okay, we'll
Let
see.
me, let me tell you this, and this, for some people, this will be comforting, and other people, it will be less comforting. Typically, people score, because people are like, whoa, I can't remember stuff from the whole course. It's terrifying. But people tend to score about the same on the final as they do on their other exams. So if you've, I know that may not be comforting. So if you average a 70% on your other exams, most people come out like somewhere between like a 65 and a 75, like plus or minus 5%. Occasionally there's people who really kill the final, like and meaning they do really well on the final, and do better than their average. And occasionally there's people who, just bomb the final. I mean, that happens in no matter what. But what I'm saying is, think about this. The final's worth 10% of the overall grade for the course. Okay. So if you got a 50% on the final, that would be like losing 5 points in the course, 5 percentage points. And so if you're, if you're sitting at a 75, then getting a 50% on the final could drop you to a 70 for the class. If you're sitting at a 80, the worst it could drop you is to a 75. So I'm not, this is not meant to discourage you. It's meant to say it's not gonna, you're gonna do fine. So don't worry, just do your best. The good news is like the other ones, if you study the study guide, that's going to be the material the final's drawn from. You don't have to try to memorize all 12 chapters. So the checklist, the exam checklist, is going to narrow it down for you as to what areas. The other thing is I don't, when I study, I start to like look at the exam questions or the study guide things as like, okay, so what question would somebody build around this? And that helps me to say, okay, so like for knowledge-based questions, to look at those and say, okay, here's a list of 4 things. I bet you they're going to say, which of the following is not one of these things, right? I mean, those questions are pretty common for multiple choice questions. And even for something like, like adjusting entries, they're either going to ask me, they're going to either ask me to make the adjusting entry for something, which is hard because that was back in chapter 4, or they're going to ask me like, this type of entry is which type of adjusting entry? Is it deferred revenue or a deferred expense, or is it? So in other words, for me, if I break it down into those sorts of things, then I really just go, okay, I really need to know the difference between a deferred expense and a deferred revenue, and an accrued expense and accrued revenue, and be able to work out an example of each. And that's what I need to do for that chapter. That helps me when I look at those bullet points on there to sort of break it down into what are the things I need to do. Now, that being said, can you know those things and still make a mistake in the math and mess it up? Yes, I do that all the time. Good news, in real life accounting, people make mistakes all the time. You just catch it.
Yeah,
And
I agree. I agree.
uh, I always tell people that like the like real life accounting is easier than class accounting, because you're not having to figure out a crazy word problem. You're just trying to find a solution to a problem, and then you find it. So short answer to your question is yes, it does. It is cumulative. It covers the whole course.
So why we couldn't review the before exam that we have done, and we can see which question will make mistake, because when we are starting, maybe some misunderstanding on somewhere, but we don't know. And then maybe we'll make a mistake again in the final exam.
No, it's a great
yeah.
question, and it's one that I have again and again provided input to the course designers on. And it's sort of beyond my control. I agree. You should be able to review those exams. But their viewpoint is exams are not the learning process, they're the measurement process. So homework, you get feedback. Quizzes, you get feedback. Those are all part of the learning cycle. And then exams are measuring, did you learn or did you not learn? I disagree with that philosophy. I'm not saying that it's an invalid philosophy, but I disagree with it. I think the exams are also part of the learning process, and providing some feedback would be really helpful. But I'm limited in what I can do by the course design. It's actually one of the big challenges of teaching for BYU Idaho. I teach for ASU, Arizona State University, and their model is like pretty much, hey, instructors, you're the subject matter experts, you make the decisions. And then I teach for Eastern Arizona College, and they're somewhere in the middle. They're like, we want things to have a consistent look and feel, but you're free to do it however you want. But BYU is like, here is the class, prepackaged, pre-made, and they're not the only school that does this, by the way. A lot of schools do this, and the instructor becomes more of a facilitator than a teacher, where we just try to guide people through the pre-existing content. So again, I've given you a very long answer to your short question. I wish.
Sorry.
No, and I wish, and I will say, and I know Hadney and I have done this. I'm willing to meet with you individually and review your exam.
Could I go over go through the before exam that I made mistake all of the question? Well,
yeah, we would just need to make an appointment, and we could do that. So I can't send your exam to you. I can't, send you a copy of the questions you missed. I can't do that. But I can talk about each one you missed and maybe why you missed it. Or sometimes people see it and say, oh, I see why I missed that one. I understand it. I just made an error. Other times, like you said, it helps you discover some more fundamental flaw maybe in your understanding of the concept, and getting that correct will help you going forward. So I'm very willing to do that by appointment. Just send me an email with a couple of times and dates that work for you. And this week I'm pretty available. Hadn't I know we were going to do that, but then we didn't. So I don't know if that was you or me. I hope it wasn't me.
No, it was me. I was out of town, and then I came, and then with my other credits, I'm taking 12 credits, and then I'm just crazy, I guess. And with the 3 children, this week was kind of hard. So are you still willing to do it another day though?
Yeah.
Okay.
Yeah. Just like I said, send me an email with a couple dates and times that work for you, and I will try. Oh, you know what? Next week we have girls camp on.
Okay.
So I'll just be up there Wednesday and Thursday.
Okay.
So anyway, so Monday, Tuesday. So tomorrow, Saturday, I think I could. Monday, Tuesday, or Friday of next week, I think I'm also available. So
all right.
maybe give me a couple times and we can do that.
Okay. Would you just look at one exam? Because I don't know how I'm gonna come out in this next one. I thought the last exam I came out pretty good, and then I saw it. I'm like, okay, then I messed up really bad some math. And I thought I was doing the math.
Yeah, no, we can try to look at as much as we can. I mean, I find that most people's brains are limited to about an hour, like 45 minutes, and your brain just starts turning into mush, and you're not gaining any more out of it at that point. Some people can go a little longer. So I mean, yeah, we can take a look at what you want to look at, and if we have to schedule another session, we can do that. And if we feel like we can, so
you wouldn't mind?
No.
Oh, okay. Okay, thank you.
That's my job. I mean, again, I'm trying to balance some schedules. So are you. We all are. That's life. Anyway, okay. So that was a long detour. Did I answer your question, Michelle, or your concern at all? Okay. All right. So let's talk about issuing par value common stock for cash. So recognize that what stock is a share of ownership in the company. And for this chapter, we're speaking from the perspective of the company. So we're the issuer of the stock, okay, not somebody else who's investing in the stock as an investment. And so each time we issue stock, we're getting cash. That's why we do it. Okay, this is why businesses issue stock. When they need to grow, they don't have enough cash. What you do is you sell a part of the company. And it's safer to sell the company to a bunch of individuals than it is to sell a big chunk of it to one person who could potentially try to take your company over at some point. And so, you know, maybe what we do is we just sell off 30% of our stock, but we sell that 30% to thousands of investors. That protects us pretty well from any sort of push to try to control our company. Ultimately, in the end, whoever owns 51% or 50.1% of the stock of a company, they control the voting power. And so you get to choose your board of directors and things like that. All right, so here's Hydroslide Inc. They issue 2,000 shares, $1 par value common stock. Prepare Hydroslide's journal entry if A, the shares are issued at $1 per share, and B, the 1,000 shares are issued at $5 per share. So the whole concept of par value in stock is old, back to early corporations. And it's kind of, I think it's obsolete, but it still gets used because it's in the state laws. Corporations are creations of state law. So when you incorporate a company, you do it under the laws of a specific state, whatever state you want to incorporate in. And so many states still require this par value, which is just this arbitrary dollar amount per share that the stock will be valued at. I don't know how else to put it. It's arbitrary. It doesn't mean anything. So in the first example, A, if we issue them for $1 per share, then our journal entry is just going to be cash goes up by $1,000, we debit cash, and common stock goes up by 1,000, we credit common stock. Now under B, it's a little different because now we're getting $5,000 for stock that has a par value of only $1,000 or $1 per share times 1,000 shares. So we have to account for that additional $4,000. And we do that by creating this special equity account called paid-in capital in excess of par value. It just means money we've raised through issuing stock above its par value. So if I issue 1,000 shares for $5 a share, and those 1,000 shares have a par value of $1, what I'm going to do is I'm going to break down the equity accounts into a common stock account, which is the par value of the stock, plus a paid-in capital in excess of par value for any amount over and above the par value. Okay. Again, if you want to, you could Google why and what that means, and you'll have lots of people's explanations. I think it's easier to just say this is how it's done. Par value is listed separately from any money received over and above the par value. That's just the way that many states do it. So the stockholder equity section for this company would look like this after that issuance of stock. We would have common stock of $2,000. That's the 1,000 we got when we issued it for $1, and the other 1,000 we got when we issued it for $5. Plus, we would have paid-in capital in excess of the par value of $4,000. So that would give us total paid-in capital of $6,000, then our retained earnings and our total stockholders' equity. All right. So in addition to common stock, we sometimes deal with something called preferred stock. Preferred stock sounds like it would be more awesome than common stock, and it is in some ways. So recognize that preferred stock is something that we usually sell to only to select individuals, usually like members of the board of directors, people like that. And preferred stock does not have voting rights like regular common stock does. The other thing is that preferred stock tends to pay special dividends and have a priority if the company ever goes out of business. They get paid off before the common stockholders do. When a company goes out of business, like declares bankruptcy, what happens is all the assets are auctioned off or sold off, and then any debt holders, so bond holders, things like that, would get paid first, and then any money left over would go to the owners, the stockholders, and the preferred stockholders would get paid first, and then the common stockholders would get whatever was left over after that. So it's preferred in relation to the dividends it pays. They get their dividends first. Remember, dividends are a share of the profits, and preferred in the event of a liquidation, meaning the business has to be sold off. Just like with our common
Excuse
stock.
me.
Yeah.
So you mean the preferred stock is only for the special person they can buy this stock?
Right, it's not typically available, like you can't just go on your Robinhood account and buy preferred stock.
It's just only for, like you said, the director is not, they cannot buy, say, in the public stock market, right?
Correct.
Okay.
And usually it's even restricted, like let's say I'm on the board of directors and I have some preferred stock and I'd like to sell it. It's usually restricted, meaning I would have to first offer it to other preferred stockholders or something like that. There's usually some restriction. I can't just sell it to whomever I want.
So how can they buy and how to buy, and that it's not a buy, or the company just give them
No,
like you said, the director will say
they purchase it, but it's only offered to certain people, and so usually, when a company issues stock, the board of directors meets together and says, hey, we want to issue this much stock. Usually you have management, like the CEO, coming and saying, we need to raise capital. And so we need to issue stock to do that. And then the board of directors would vote on it. And then if they all agreed, they would issue that stock. And preferred stock is the same way, but it's just a much more limited offering. And it's not offered to the public in the same way that common stock is. You know, so maybe you're on the board of directors, or maybe you play tennis with the CEO. And he knows you're really rich, and he says, hey, we're trying to raise some funds. Would you like to buy some preferred stock in the company? That can be done that way.
So you think that it's the how to say, it's not a public fair business. Correct. For the stock box, right?
Correct.
It depends on the CEO how he wants to do. But if for the LLC company,
no, it has to be a corporation. Only corporations have stock. But the same thing can happen in an LLC. Okay, my wife and I own an LLC, and actually I own 50%, and my mother owns the other 50%. We could, if we both agreed, since we're the only owners, okay, we could agree to sell a portion of our capital in the company to another person if we wanted to. It's just that stock is a way of doing it that's very easily transferable. And what I'm saying is preferred stock is not as transferable as common stock. In other words, not as easy for someone to sell it, because when there'd be restrictions on it. The same like with a partnership. Partners can agree to sell a share of their partnership interest to someone else, but everybody has to agree to it. With common stock, that's not the case. Once the stock shares are issued, anybody can sell them to anyone. They're publicly tradable. But preferred stock is usually not. That's all. Okay. Yeah, no, it's a whole different area that, like, I've never owned preferred stock in any company. I'm just a lowly teacher.
I have a question.
Okay.
Is there something in specific, and it might be a dumb question, but is there something in specific that makes it preferred?
Yeah, so it's this preferential treatment for the shareholder in dividends. They're going to get their dividends first. So if the company pays dividends, it pays to the preferred shareholders first, and then any dividends left go to the common stockholders.
Oh, yeah, no, what I mean is like, how do you, like, is there a specific part of the company or part of stock that makes that part preferred? Or is it just because the CEO tells you directly that this is preferred stock and not common stock?
Yeah, so it's just a different class of shares. It'll be printed right on the certificates for the shares that it's a different type of share.
Oh, okay.
Right.
Thank you.
All right. So here's an example. Stein Corporation issues 10,000 shares, $10 par value preferred stock for $12 cash per share. So our entry is going to look like this: 10,000 shares at $12 per share is going to give us $120,000 in cash. 100,000 worth of it will be listed as preferred stock, and the other 20,000 will be paid in capital in excess of par. So really, it behaves, at least from the journal entry standpoint, the same as common stock, right? That we're going to record our par value separately from our paid in capital in excess of par, and then the two of those together will be the total amount of cash we receive from issuing the stock. Just like in some states and some areas, common stock and preferred stock might be called no par. So it doesn't have a par value. If that happens, then we just record the whole amount to the stock account when we enter it, if you ever see one that's a no par. So treasury stock. So treasury stock is common stock that has been issued and is already outstanding that the company then buys back. So remember that companies issue stock because they need to raise money, they need to raise capital. So they sell a portion of the company off to investors. So sometimes when a company starts to do well and has plenty of money, they'll buy some of that stock back. When they buy it back, they can either cancel that stock and say these shares are no longer outstanding and available, or they can hold them as what's called treasury stock. And treasury stock is shares that are out there and available, but the company actually owns them. A lot of times companies hold treasury stock to use in their employee stock ownership plans. So when their employees want to buy stock in the company, instead of having them going out to the stock market and taking the current price, they'll sell them the treasury stock. Especially if, let's say, they were able to buy it back at $8 a share, and now the market's trading at $15 a share. They can not only sell stock to their employees, but they can make a profit on it. Okay, so that's awesome for everybody. The employees getting their shares and the company's making money on it, instead of having to buy it at the market price. So treasury stock is a contra account, meaning it reduces the amount of equity in the company because it's not out there being owned by other people. It's just sitting there and remember, this used to all be done with like paper certificates that showed each share of stock. Now it's just all done electronically, so it seems a little more, you don't have like this paper stock certificate to prove you own the stock. It's just in your electronic account. So on February 1st, Mead acquires 4,000 shares of its own stock at $8 per share. Prepare the entry. So we always just record treasury stock at the cost that we buy it at. So 4,000 shares times $8 per share, 32,000. So whenever we acquire treasury stock, our treasury stock account goes up with a debit and our cash goes down with a credit. So now you'll see on the balance sheet, we'll have our paid in capital, which is our common stock for this example, retained earnings, and then at the bottom it'll say less treasury stock. And usually the number of shares will be shown or disclosed is their term, and we subtract that out from our total stockholders' equity. Because remember, stockholders' equity represents the amount owned by the shareholders. And this 32,000 is no longer owned by the shareholders, it's owned back by the corporation itself. Okay, so a dividend, if you remember from earlier in the course, a dividend is a share of the profits of a company paid out to the owners, paid out to the shareholders. So typically dividends are paid in cash. So in order for us to actually be able to pay a dividend, we have to have some funds in retained earnings. We have to have the cash available to pay it. And then we have to have this declaration by the board of directors. The board of directors actually has to say, we're going to pay a dividend. Not all companies pay dividends. Some choose not to instead reinvest all of their earnings into the growth of the company. So here's an example of a cash dividend. On December 1st, Media General declares a 50-cent per share cash dividend on 100,000 shares of $10 par value common stock. The dividend is payable January 20th to shareholders of record on December 22nd. So there's a couple of dates that are all happening here. The first is what's called the declaration date. That's where the directors of the company agree we're going to pay a dividend. And so they declare it. The second date is the date of record. That's the date at which you have to own the share of stock in order to get the dividend. So only shareholders that have it on the record date are going to get the dividend. And then finally, the payable date is the date when the dividend's actually going to be paid. So on the declaration date, what we're going to do is we're going to create an entry that will look like this. Since it's 50 cents per share times 100,000 shares, it'll be $50,000. And we're going to debit the cash dividend account and credit dividends payable because we haven't paid it yet. We've just declared it. But once we declare it, we owe it. Okay, we owe that to the shareholders. So that's what happens on the declaration date. A debit to the dividends account, a credit to the dividends payable account. On the date of record, nothing happens. Other than somewhere we're saying, somebody's making a list saying these are all the people, all the shareholders that are going to get a dividend, but no financial transactions occurring on the 22nd. Finally, on the payment date, we'll debit our dividends payable account and we'll credit our cash account, meaning we'll actually pay the dividends out in cash. So each time there's a cash dividend, there's going to be these 3 dates. And on the first one, we'll debit dividends and credit dividends payable. The second one, there'll be no entry because there's no financial change. Just that's the date people had to own the stock by. And then on the payment date, we'll debit dividends payable and cash and we'll credit cash. So in the end, if you think about it, the cash dividends account would end up have a debit balance of 50,000. The cash account would get a credit of 50,000 and dividends payable would end up with a balance of 0. So in the end, it's just, that's how it goes. All right. All right. We talked about the fact that preferred stockholders have a right to receive dividends before common stockholders. Okay. So what happens is the company will say, hey, we're going to pay a dividend of $1 million. And so what they do then is calculate the amount that goes to the preferred shareholders, and that goes first, and then any amount left over out of that million is what will be split among all of the common shareholders. Okay, so that's the process. The other thing to recognize is that sometimes a preferred stock will have what's called a cumulative dividend. A cumulative dividend, which means that the preferred shareholders, if there's a year when the company doesn't pay dividends, then the next year, before it can pay dividends, it has to pay them for the previous year's dividends and this year's dividends before it can pay anything to the common stockholder. So preferred stock often has what's called a cumulative dividend, meaning their dividend is going to be paid. Even if they miss a year, that has to be made up, okay? And so the term for that is dividends in arrears, meaning dividends that haven't been paid yet, that are owed, okay? And oftentimes with preferred stock, the dividend is going to be listed as a percentage of their par value. And I'll show you an example of that here in a minute. So just recognize that preferred stock can have these dividends in arrears, which means that you have to pay the previous year's dividend and the current year's dividend to the preferred shareholders before the common stockholders get paid.
Sorry, I have a question here.
Okay.
I know right now the stock market, some company before they share the dividend, but the COVID-19 they stopped to share the dividend.
Mm-hmm.
That me like before that page, you said that is impossible. If the pandemic is over, then they will pay the cumulative dividend to the stockholder, or just only for the preferred stockholder.
Yeah, good question. So common stock never has cumulative dividends, meaning the board of directors can choose to pay a dividend or not, and it won't. There's nothing cumulative about it. It doesn't add up. So if you own common stock, it means you're sort of at the mercy of the board of directors whether or not they're going to pay a dividend. They could just choose not to pay a dividend. Now, as a shareholder, you get to elect the board of directors, right? So if you get to vote on the board of directors. So in theory, if enough people wanted a dividend and the board of directors wasn't paying a dividend, they could all vote to remove that board of directors and replace them with a board that would do that. What's challenging about being an individual investor, like, maybe you have 100 shares of this stock or something, is that institutional investors like mutual fund companies and employee retirement plans, they own many more shares of stock than any of us. And so, any vote that I might make is just kind of swallowed up in really the big mutual fund companies. They get to decide who the boards of directors are for these corporations, and even then, usually the corporation will retain ownership of most of the shares of stock. So it's so you do that. If I started my own company and then I sold off a portion of it, I would never sell off more than 49%, so that I always could control who was on the board of directors, right? And so that means people investing in my company would have to understand that even though I'm willing to sell this to you, I'm not willing to sell control to you. And so you can participate in a passive way, earning some of my profits or not, but I'm not going to give you control. And so I guess as a buyer of stock, as an investor, you need to be aware of that you really are investing quite passively. You're just sharing. And so you can, what I do is I look at the history of the dividends a company pays. If I'm looking for dividends, and if I see a company with a long history of paying dividends, then I'll buy that company. If I'm not interested in dividends, instead I'm interested in growth, I might look for companies that, with that history. But there's no guarantee. I own a company called Iron Mountain, which is a real estate investment company. It pays a really nice dividend, about 8% a year in dividend. So even if it doesn't grow in its capital price, I'm still getting an 8% return on it. But if business started going bad and they decided to cut dividends, I wouldn't really have any recourse other than to sell it, or wait for it to drop and buy a whole bunch more of it, hoping they'll start the dividends up again when business gets better. All right, so I always give long answers to short questions. Some people are like, I like that, and other people are like, I just won't ask any questions because this guy talks too much. Sorry. All right, so here's our example. Scientific Leasing has 5,000 shares of 7%, $100 par value, cumulative preferred stock. So the things that we have to clue in on here are the 7% $100 par value, and cumulative, okay? When it says cumulative, that means it pays dividends in arrears, okay? We'll have to maybe make up dividends for preferred shareholders. And if we want to know the amount it pays 7% of the par value, or $7 per share, okay? 7% of 100. So this tells us each $100 share pays a $7 dividend. The annual dividend is $35,000, which is 5,000 times $7 per share. So if the dividends are 2 years in arrears, preferred stockholders are entitled to receive the following dividends in the current year. If it's 35,000 per year, because it's 5,000 shares times $7 a share, they would be entitled to receive $105,000 in dividends before I can pay anything to the common shareholders. So if this company had declared a $200,000 dividend, first thing we would do is pay the dividends in arrears. Then we do the current year's dividends. Then the remaining $95,000 would go to the common shareholders. Sometimes, in addition to cash dividends, a company might like to pay a dividend to its shareholders. See what I said? We have about an hour, and now Hadney's looking exhausted. See, we only have an hour, and then people are worn out. Granted, you're dealing with kids, which means you have like 20 minutes. It gets lower and lower how much time you can handle trying to think of two things at once. You're a mom, you're a multitasker, right? Anyway, so here they declare, sometimes they pay a stock dividend, which means instead of paying their dividend in cash, they pay it with stock. They just give you more shares of stock. As an investor, I love that. This is a way you can reward your shareholders and say, we are making a profit, but we don't want to give away any cash because we're using that cash for other things. Okay. So here's an example. Medlin Corporation declares a 10% stock dividend on its $10 par common stock when 50,000 shares are outstanding. Okay. So the market price was $15 per share when they did this. So if we say a 10% stock dividend and there's 50,000 shares outstanding, that means we're going to take 10% of 50,000. We're going to issue another 5,000 shares. If somebody owns 100 shares, they're going to get 10 shares as their dividend. If somebody owns 1,000 shares, then they're going to get 100 shares as their dividend. Okay, so this just little chart kind of shows you what happens. So before the dividend, there was $500,000 in common stock, 300,000 in retained earnings, so a total stockholders' equity of 800,000, and 50,000 outstanding shares at $10 par value. The stock dividend is going to issue another 5,000 shares. They're selling at $15 on the market, so we're going to record that as $50,000 in common stock, plus another 25,000 in paid in capital in excess of par, because we're issuing these at 15. And then to pay for that, so in essence, when we do a stock dividend, all we're doing is we're giving a certain number of shares to the shareholders at the current market price, and then paying for that with our retained earnings. Okay, we're issuing shares and paying the cost with retained earnings. So after the stock dividend, we'll now have $550,000 in common stock, 25,000 paid in capital in excess of par. We'll have 75,000 less in retained earning, so our total stockholders' equity will remain unchanged. We just used retained earnings to buy shares of stock at the market price and then give those shares of stock to the current shareholders. That's what happens with a stock dividend. All right, sometimes there's a stock split. So that's different than a stock dividend because we're not actually issuing any more shares. Most often a company will do a stock split because they want to keep their price range of their stock at a level that is attractive for investors. Some people just don't like investing in shares of stock that are really expensive. And so when a company does a stock split, what they'll do is they will actually, so this is called a 2-for-1 stock split, meaning every shareholder that has one share is now going to get another share. So they'll end up with 2 shares for their one, but they'll cut the price of the stock in half. So if I had 100 shares at $10 a share, after the split, I'll now have 200 shares at $5 a share. This doesn't change the value of my stock investment at all, but I have twice as many shares. So if it starts to go up, it's going to benefit me because I'm going to get, twice as much growth in that sense. So a stock split, what this does from the company standpoint, you'll see here they had 500,000 and 300,000 in retained earnings, total stockholders equity of 800,000 with 50,000 outstanding shares and a par value of $10. After the split, all we're doing is adding more outstanding shares, but reducing the par value. And so in the end, none of these values change except the number of shares and the par value. Okay. So this is how somebody long-term actually can do really well. I met a lady once who bought a couple hundred shares of Coca-Cola in 1950. But when she was in her 80s, she didn't know her husband had bought it. She never looked into it. It was just sitting, the old stock certificate was sitting in a shoebox in her spare bedroom. And we did the math, and because of all the splits over the years, she now had about 70,000 shares of Coca-Cola worth about $1.2 million sitting in a shoebox in her spare bedroom, which is cool. But that's what happens with splits is she had 200 shares and then it split 2-for-1. So then she had 400 shares, but the value had dropped, but then it continued to climb because everybody drinks Coca-Cola and their products. And then it split again, and her 400 shares went to 800 shares, and then it split 3-for-1, and that 800 went to 2,400, and so forth over 60 years. So that's a stock split. I think most people have heard of them, but how they actually work financially, it's actually simpler than you think. Twice as many shares, half the cost, or half the value, right? Par value. All right, here's just sort of a summary of the difference between a stock dividend and a stock split. A stock split, nothing changes except the shares outstanding. Wait a minute, that's confusing. We just showed that there's no change in total stockholders' equity on a stock split. Ignore that slide, it's confusing. And it's not right, actually. So, okay, so that was a ton of information, I know. And then me adding extra stories to it about ladies with shoeboxes just gives more information, which probably doesn't help settle it all in your brain. Any questions I can try to answer? And I will try to give succinct answers to your questions instead of rambling answers. My student evaluations at the end of every semester are like 90% of students are like, he tells all these stories and he's funny, we love that. And like 10% are just like, he talks too much. So it depends on the student. Some people like it. Anyway, what can I do to answer questions? Or are we good? Is that enough for one day?
So far, I'm good. No
Okay.
question. Thank you.
I think I'm all right too.
All right. Well, terrific. Well, again, so shoot me an email with a few dates and times, and we can try to get together and go over, review some stuff. And then that's it. And have a really great day. Michelle, would you be willing to offer a closing prayer?
Sure, my pleasure. Dear Heavenly Father, we thank Thee we can have the meeting time to increase our knowledge in the financial accounting. We thank Thee we have the very great instructor to help us to grow in this course. We ask Thee to help us to continue we ask Thee to increase our wisdom and ask Thee to continue to help us to have more patience to continue to learn more to help in our real life. We actually to help us to be successful in this semester. We still have the 3 weeks to go through. We actually to help us to have energy to continue to the end. It's our humble prayer in the name of Jesus Christ. Amen.
Amen. Thank you. Thank you so much.
You're
Have a great
welcome.
night.
You too. Have a
All
good
right.
night. Bye.
Bye-bye.